Remember when the housing market was normal before the pandemic? Don't you feel like things have taken a kooky turn into some alternate dimension? Well, guess what? You're wrong. The housing market has never been normal. Before 2008? Nope. How about back in the 90s, before the dot-com crash? Nah, home skillet. You see, the housing market is its own thing. Economists call it counter-cyclical, meaning it moves in the opposite direction of the overall economic cycle, which means things can get a little funky. Today, we'll take a look at where the housing market might be headed and how to make the most of the current reality, whatever that means, in what we're calling the new normal. Hi, I'm Delaney Yeager, and this is Zillow Explains, where we break down housing market data and real estate trends. First, a quick history lesson. In 2008, home foreclosures triggered an international financial crisis that took nearly a decade to recover from. We had just put that chapter behind us when COVID hit. Millions lost or quit their jobs. Some embraced a nomadic lifestyle, others left for the suburbs, buying homes where they could work from home and school their kids from home and start sourdough starters at home and get really into latte art at home, too much coffee and then try to go off coffee at home and then attempt to stay sane at home. Realize that maybe there's something missing in their life at home. And their therapist was like, wow, you're different. And I was like, they were like, home values shot up across the country as remote workers moved to less expensive places. Mortgage rates dropped to below 3%, triggering a home buying frenzy, while those who owned homes refinanced in droves. On top of that, home builders suddenly couldn't get enough supplies or labor. The price of lumber doubled. Supply chains were delayed. It was all very, very not normal. But the economy was remarkable. It recovered pretty quickly as everyone adjusted to the new reality. Sales surged as buyers gobbled up homes available on the market. That drove up prices to record highs with fierce competition to buy. At the same time, demand for rentals took off, causing monthly rents to rise. Fast forward to spring 2022, when the Federal Reserve changed course to tamp down inflation, causing mortgage interest rates to almost double. Owners blessed with those pandemic-era low mortgage rates were more likely to hold on to their homes for dear life, which led to the situation we're in now. Low inventory, record-high home prices, elevated interest rates, and higher rents. Yay! But how much of that dynamic is here to stay? While try as I might, I can't tell the future, we can try and guess where things might be headed. Let's talk affordability. Buyers have been hit with a double whammy of higher home prices and mortgage rates that have nearly doubled since pre-COVID. On top of that, they're contending with higher costs for homeowners insurance. In December 2019, the typical mortgage payment in the US was $896. In January 2025, it's, brace yourself, 2,550 big ones. Yikes. At that rate, it would take a household earning the national median income about 12 years to save for a down payment on a $360,000 home. 12 years is a long time, that's a full kid. So home values would have to fall far more than we've forecasted to get back to what a typical monthly payment used to be. Lower mortgage rates would help, but it looks like those are gonna stay pretty high for a little longer. I'm so sorry, please don't troll the messenger. Now let's look at home costs. From December 2019 to May 2023, the typical US home value shot up from $244,000 to $350,000. Mortgage rates and the affordability challenge have slowed price growth way down. In some places, home values even started to decline by the end of 2024, but they're still way above what they used to be. The new normal inventory. The supply of for-sale homes in the US had been struggling even before the pandemic began. See all that not normal stuff again? Builders were still spooked by the 2008 recession, and new construction just wasn't keeping pace. Since we're now living longer, we need our homes for longer, but there's also a whole new generation of people who need their own places. Before COVID, the US was already facing a shortage of 4.3 million homes. Now, that shortage is up to 4.5 million homes. Builders have responded to the demand and picked up the pace, but it's just not enough. As homeowners gradually get used to higher mortgage rates, they may be more willing to give up their low rates and sell. One reason inventory has struggled until recently is that sellers are often buyers too. The housing supply only grows when new homes are built or someone sells and doesn't buy their next home. That's happening more often as the large baby boomer generation finally retires. You know that silver tsunami people are talking about? Whoa, yeah, that one. Until very recently, some 70% of sellers were also buyers. That's now down to 60%. But until more sellers list their homes and more new homes are built, low inventory and faster sales will be part of the new normal. The new normal in work. For a while, it looked like remote work was here to stay, but 2025 marked the beginning of many return-to-work policies. One 2025 study found that about 68% of U.S. employers still offer some workplace flexibility, but they've been increasing the number of days they want their workers on site. It looks like now people are being pulled closer to expensive metro areas. So say bye-bye to those comfy soft pants and hello to those awful hard pants. It could mean higher rent prices and higher home values in popular job centers. Those barriers to buying could mean the first home for more families will be a single-family rental. Buyers will likely be in a pretty tough spot for the foreseeable future, but there are some bright spots out there. Sellers are sitting on a ton of equity from the run-up in house prices, and we're seeing signs that they're not as wedded to those low interest rates as they were a few months ago even. This could help loosen things up a bit. The best thing a buyer can do is be prepared. Determine your budget and keep track of interest rates so you can move quickly when they drop. The viability tool from Zillow Home Loans can really help here. It updates every single day with your latest affordability estimate based on current mortgage rates and your overall financial picture. It's so useful. For sellers thinking of moving, remember it can take months to prepare your home for sale. So if that's in your future, maybe start getting ready now. We've linked a lot of helpful resources and tools in the description box below to help you achieve your housing goals in the new normal, whatever normal may mean. Thanks for watching.